how you doing? This is Adam Post, publisher of more than 1,000 comic books and marketing expert covering Disney. Disney is still in a state of chaos even 1 year after Bob Iger took over the company. Now we're finding out what Wall Street wants from Bob Iger as he holds another annual town meeting with key executives. Let's get into the story. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. I really appreciate you guys. Coming from The Hollywood Reporter, Disney Town Hall preview, what Wall Street wants from Bob Iger at the annual event on November 28th, and that is today. With Hulu and its theme parks empire in focus, the CEO could face questions about how to fend off activist investors, fix the studio, and decide on possible deals involving its linear TV and ESPN businesses. This is where Bob Iger has a high-level meeting with their employees. Their employees get to ask some questions. He gives them some answers. We have a lot of coverage in this article from Wall Street people, and the Wall Street people are the analysts that really set the narratives for Disney. Bob Iger does still have to impress the Wall Street people. The Wall Street people are not yet calling out Bob Iger, and maybe it happens today. It's got to happen soon, because there's already been a public filing, but they haven't called him out yet on how Disney has now openly admitted that its social goals are taking priority over their profits. It's not something that's come up directly from any analysts yet, but the story keeps getting bigger and bigger. I saw it on John Turley's website. I saw it on Fox News yesterday. They are starting to get that word out there. Once that clicks with analysts, that will be very interesting to see, because then Bob Iger has to defend against the financial people what Disney has been doing by ruining all their brands to fit some kind of progressive agenda. Disney's decision to bring back longtime CEO Bob Iger to replace beleaguered Bob Chapek on November 20th, 2022, the stock closed that week at $98.87 amid hopes Bob Iger could right a struggling ship. On November 28th last year, Iger used the town hall meeting to outline first priorities and told staff that he did not expect the company to make any significant acquisitions during his second run as CEO. Quote, "We have a great set of assets here," he said. "Nothing is forever, but I am very, very comfortable with each of the assets that we have." Fast forward exactly 1 year, and some things have changed for the better for Disney, with Iger having focused on cost cutting, putting Disney on track to achieve supposedly $7.5 billion in cost reductions. And while they have laid off a lot of people, it's not as many people as they've claimed. A lot of jobs were just canceled. They didn't hire people for jobs that were in their plan to hire on. Additionally, some kinds of cost saving that they do is they just take shows off their streaming service, say, okay, look, it was a one-time thing. We're going to charge ourselves an expense of $2.4 billion. Look how we're reducing expenses. It's not really as drastic as they make it out to be, and it should be a lot more drastic at Disney. But the conglomerate stock has remained under pressure, ending the pre-Thanksgiving session at $95.07, below its year-ago level, as investors and analysts are waiting for more clarity on Iger's next steps for Disney. Moffett-Nathanson, probably the #1 Disney analyst that always gets cited, in a November 9th post said he was maintaining his buy rating on the stock at a $115 stock price target on Disney, noting the stock's challenges over the past year. Quote, "On November 21st, 2022, upon the news of former CEO Bob Iger's return to Walt Disney, we upgraded Disney to buy with a $120 price target. Despite Iger taking many of the quick and dramatic actions that we expected from him, Disney's stock price is down 8% since our upgrade versus an 11% upward move for the rest of all major stocks over that time, for a very disappointing 19% underperformance. In this environment, activist investor Nelson Peltz's Trian Fund, one of the company's largest shareholders, has boosted his stake in Disney further and signaled another potential push for board seats after abandoning a proxy battle in February in a big win for Iger. Value Act Capital, another activist investor, has also built a notable stake in Disney and has been in dialogue with the conglomerate's management, according to CNBC. Value Act is a similar kind of company to Nelson Peltz's Trian Fund The difference being Value Act is supporting Bob Iger and Bob Iger's strategy for Disney, which essentially is to go woke and use the theme parks to generate as much money as possible while playing funny games with their financial reporting. With that as a backdrop, Iger is getting ready to address another staff town hall on Tuesday, today, and observers will listen out for possible new hints or guidance for what the next phase of building will bring after the problem-solving phase. After all, Iger said on a recent earnings call, quote, "While we still have work to do to continue improving results, our progress has allowed us to move beyond this period of fixing and begin building our businesses again." In line with that, an internal memo said that the town hall would focus on future building opportunities for the conglomerate combined with our portfolio of valuable businesses, brands, and assets, and the way we manage them together. Disney has a strong hand that differentiates us from others in our industry, Iger argued. The CEO also used the earnings update to share 4 strategic priorities: making Disney's streaming business profitable, building ESPN for the digital future, improving the output and economics of our film studios, and expanding the company's live experiences business. In September, Disney put a spotlight on that final priority, unveiling plans for a $60 billion expansion of its theme parks, cruise lines, and other products and experience businesses. That $60 billion is to be spent over a 10-year period of time, with them upgrading existing theme parks. That's not for them to go and start like a risky new theme park somewhere. That's actually a good investment for them and a sensible thing for them to do. But questions still abound about Disney. Quote, "Disney is continuing on an ambitious cost-cutting strategy that is likely causing some uncertainty within the Magic Kingdom," Third Bridge analyst Jamie Lumley warned in a recent report. As the business looks to slash costs and make streaming profitable, there are sure to be concerns about cutting too deep and impacting the business going forward. That's just a general strange criticism because it's pretty well known that Disney is well overstaffed and has multiple layers of people they really don't need. With that in mind, Wall Street will listen out for possible color, body language, or even outright updates on various topics during the town hall, at which Iger will be joined by film unit head Alan Bergman, Dana Walden, who leads the TV business, ESPN chair Jimmy Pitaro, and theme parks and experiences head Josh D'Amaro. Here's a look at some of the key issues in Observer's focus. Re-energizing the studios. Putting the studios back on a successful path is a particular priority for Iger. He has described his turnaround recipe as including a focus on core brands and franchises and reducing output overall to enable us to concentrate on fewer projects and improve quality while continuing our efforts around the creation of fresh and compelling original intellectual property. The CEO even acknowledged on the call that our performance from a quality perspective wasn't up to the standards we set for ourselves, concluding, "We're working to consolidate, make less, focus on more quality. Only time will tell if the town hall will bring further updates on this. However, financial evidence of improving trends is likely to take a while to materialize." TD Cowen analyst Doug Kreutz, who has a market perform rating and $94 price target on Disney shares, in a recent report expressed concern, quote, "that problems at the studio are more complex," adding that "we markedly disagree with management's prognosis," noting that the company indicated a heavy focus on core brands and franchises and reducing output overall. Quote, "to concentrate on fewer projects and improve quality." He wrote that management also said that at the time the pandemic hit, we were leaning into a huge increase in how much we were making. Quantity can be actually a negative when it comes to quality. But here's his take. Quote, "we don't quibble with any of the broad strokes here. Where we disagree is that too much film output is not actually what happened, at least when it comes to Disney's key content engines. The expert sees a different problem. If the argument is that Disney spent too much money making non-branded films, largely as a result of the Fox acquisition that Iger himself did put together, that's fine, but even there we would say that overinvestment at the Fox studio should not have had any impact on what was going on creatively at Marvel and Lucasfilm and at the animation studios." His conclusion: ultimately, Disney's theatrical run during 2016 to 2019 was unprecedented and is unlikely to be duplicated. However, performance can certainly be better than it has been over the last several years. We think improved performance is not just a case of quality over quantity. It's going to take some different decisions about prioritization for film versus streaming, a better curated mix of products in the pipeline, and probably a bit of new blood in the management ranks as well. Overall streaming progress. Disney has stated that it plans to roll out a unified streaming experience domestically that effectively combines Disney Plus and Hulu. Management's hope is to increase engagement, create more advertising opportunities, lower user churn, reduce customer acquisition costs, and increase overall profit margins. And the company's target is to still turn profitable in its combined streaming businesses in the fiscal fourth quarter of 2024. Disney is planning to launch a beta version of its new streaming bundle in December ahead of an official launch in early spring. Some have wondered if Iger could provide an update on this during the town hall. Quote, the company also expects to continue actively exploring ways to address account sharing, but given the timing of planned rollouts, Disney doesn't expect a meaningful impact from these actions until 2025, Goldman Sachs analyst Brett Feldman wrote in a recent report. PP Foresight analyst Paolo Pescatore said Disney's recent quarterly earnings were encouraging for the streaming business and showed Iger's turnaround plan is in full swing. He particularly touted Iger's focus on getting to streaming profitability, saying the firm seems to be benefiting from what he dubbed the Netflix effect. Explaining Pescatore, quote, integrating Disney Plus along with Hulu in the future will put the company in a strong position to drive subscriptions, engagement, and importantly, revenue, either through subscription or advertising. Overall, the analyst sees Iger using cost cuts to free up money for focused investment. Quote, these latest results clearly underline a razor-sharp focus on efficiencies across the board while focusing on content, he said. This is in stark contrast to other traditional rivals who lack the same scale as Disney in this new streaming-driven world. But others remain more cautious. Quote, we don't doubt that Disney will attain streaming profitability. It's just a question of how much, according to T.D. Cowen. The amount of degradation they see in the rest of the entertainment business also matters, and ultimately how much growth they can get out of the combined total. While this may work out okay on balance over the long run, we still view the outcome as extremely cloudy and likely to remain so for the next few years. Disney's overall deal-making. While Iger signaled no big acquisition plans a year ago, talk about various deals and possible deals has since moved into focus. Early this month, Disney agreed to take full control of Hulu in a deal with Comcast, which has owned a third of the streamer ever since Disney's acquisition of Fox's entertainment assets. Disney expects to pay at least $8.61 billion by December 1st, meeting the floor valuation for Hulu agreed with Comcast, but this will go through an appraisal process with the selling partner to determine if and how much more the company may need to pay. So that'll probably be between 10 and 15 billion, but we'll find out. Disney could use the town hall for an update on Hulu. Some analysts expect a deal for Disney's India business, including streamer Disney Plus Hotstar and Star India could be next, whether an outright sale, the sale of a stake, or joint venture. After all, Disney's footprint in India has come with a substantial cost. Wall Street has also been waiting for more clarity on the potential sale of Disney's linear TV assets and a stake in ESPN. While the conglomerate did not announce a partner for ESPN with its earnings update, it reiterated that it had seen strong interest from parties that could assist with marketing, technology, distribution, and new content. Meanwhile, Swinburne doesn't expect any near-term news on a possible deal for Disney's linear TV assets. Quote, the cord-cutting and advertising trends remain challenging heading into fiscal year 2024, he wrote recently. While Disney has discussed publicly the potential for asset sales in this group, it does not sound like a near-term priority to us. Rather, operating these businesses more efficiently appears to be the near-term goal. Whether or not he is right, any town hall commentary on the likelihood, possible focus, or timing of any potential Disney deals would draw much interest from analysts, investors, and company staff alike. Quote, Disney is at a fork in the road and needs to choose what path to take, Third Bridge analyst Lumley said in a recent report. Although the company delivered improved streaming results in its most recent earnings, Disney's linear business continues to come under pressure both in the US and internationally. If Disney wants to sell those businesses, it needs to make a decision before the decline becomes too severe. So if they don't sell the businesses before the businesses fall apart, they're probably not going to be able to sell them. I don't think they're going to sell them. Even in the absence of tangible news or developments on that or other fronts, the town hall will give Iger and his team a chance to reiterate key strategic priorities and messages to boost staff and investor confidence and to keep doubters and critics at bay. We will see about that. Disney always has a lot of doubters and always has a lot of critics since they went woke. Some on Wall Street came out of earnings season liking what Iger has done and predicting more upside ahead. Bank of America analyst Jessica Reif Ehrlich, for example, remains optimistic for Disney despite a rocky road to recovery. She reiterated her buy rating on Disney shares with a 110 price objective. Quote, while several strategic questions remain, we remain confident in Bob Iger's ability to navigate the company through this transition period, she wrote. Near-term catalysts include additional updates on strategic priorities for Disney and continued robust theme park demand. In his recent report, Nathanson summarized his take on Iger's work and Disney stock this way. Real change takes time. His explanation for the stock struggles. Quote, a combination of linear pressures, weaker global advertising revenues, accelerated U.S. cord cutting, higher sports costs, poor global box office performance, and slower direct-to-consumer revenue growth have been the driving factors of the underperformance. The expert then shared a somewhat mixed review of Iger's various initiatives so far. On a brighter note, Iger quickly returned the organization to its prior structure. Further, he has aggressively raised prices on Disney Plus and reduced regional content investment and non-core general entertainment spend to focus the product back to core consumer expectations. The impact from these two moves are not immediately measurable as content slates take a while to develop and existing amortization from overinvestment stays on the profit and loss statement for a few years. Yeah, Nathanson, except the fact that Bob Iger did write off at least $2.4 billion worth of content spending in this one-time charge, which actually makes Disney look more profitable than it is because instead of writing that off over time and expensing that amount over a couple of years, they get to do it all at once. And then in future quarters, they look like they're more profitable because that expense isn't there anymore because they took the expense all at once in the past. Meanwhile, on the negative side, Iger's open and honest disclosure about his worries about the long-term health of the linear networks has frustrated the market because it wasn't matched by an immediate action step. As such, we've been needlessly left wondering and postulating about assets that are no longer drivers of future company earnings. Overall, though, Nathanson sees a light at the end of the tunnel. Quote, Disney appears to actually be on the precipice of improving financial returns in the non-parks divisions of the company, he concluded. The single most critical takeaway from the fiscal fourth quarter earnings call and press release is the focus on driving free cash flow back to pre-pandemic levels. Guggenheim analyst Michael Morris is also bullish on Disney's outlook, recently maintaining his buy rating with a $115 stock price target. Quote, we are bullish on intense content quality focus, moving past Hulu ownership complications to maximize asset value, right-sizing spending, and giving more consumers more opportunity to pay for ESPN via a direct distribution tier, he wrote. But he also mentioned an area of regret, saying, quote, we are lukewarm on the incremental value of more Hulu Disney Plus integration. We wish the company would get more aggressive with the Hulu virtual multi-channel video programming distributor, which basically allows it to act like it's a cable company offering multiple channels. And we're bearish on potential substantive impact from strategic partners from the tech and content community. Lumley also sees challenges for the Disney CEO and his team in outlining his vision for a brighter future. Quote, Bob Iger has talked about how he wants to move beyond fixing problems to build businesses. This could be a hard message to sell as the studio segment limps through some recent disappointing box office results, like the Marvels, even while there are ambitious future plans for the company like launching ESPN as a fully fledged streaming platform and integrating Hulu into Disney+. Wall Street analysts have not all given up on Bob Iger yet. None of them seem as confident about Bob Iger as they were 1 year ago when he came back to the company. I'll correct that. I think there's one guy in there that says he's very excited about Bob Iger still. The rest of the people can't help but notice all the box office failures and the fact that the business overall does have substantial challenges that are just normal business challenges, dealing with the cable losses and the change to streaming and streaming being such an enormous business for Disney, but really they're not experienced with it. They don't have the kind of experience that the Netflix people have running that business profitably. That's like an actual normal business challenge as opposed to all of the problems they bring on their box office results, on their licensing, on the value of their intellectual property catalog because they keep destroying all their brands to make them try to fit into the woke agenda. As Disney tries to come up with a better explanation for why their box office results are consistently so bad, we'll see how the analysts respond. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up, and I'll see you again soon with another video. And if I don't see you, I will miss you.